Welcome to StockOdds Odds End Podcast. This is Dave and Rob getting ready for the week ahead. Good evening, Rob.
Good evening. Well, we are on the back of a shortened week and going into a full week. So we'll see. Let's review and then see where we go from here. Thank you for joining me today here.
Always a pleasure.
So I just want to review what happened on Friday because it was an important day. It was Expiration Friday, third Friday of the month. We have seasonality on that. We'll review a little bit later, but nonetheless, we kind of we're sloping down from the pre-market high towards the open, and we opened and dropped a little bit. So always watch for previous close testing, a gap fill, anything like that. In this case, we rejected it. We tried again at the 10 a.m., which half an hour into the day is often a pivotal time to watch. We do also have news that comes out often at that time as well as, the 8:30 session and then 10 a.m. So keep that in mind. But we tried again to tag the previous close, and we failed in a good way, meaning that it started to slope back up, tested the intraday high, and then wanted to go and rally to test the pre-market highs. And then we started to climb, and we see very high signal here. This is what I mean by high signal, where we're walking the upper Bollinger Band. It's high signal to noise ratio, and it's pulling back just to the simple moving average, which is the 20-period moving average by default there when you're using Bollinger Bands. So pulling back and continue to climb all the way pretty much to the close. So quite a distance between the VWAP. You're not always going to get VWAP reversion. Sometimes there's tests along the way, like what you see here twice, but it can certainly distance itself from that. So this was a very important day, and we can build on that possibly. This is what it looks like on the daily for the SPY. And this is all-time highs now. We're into new territory, and so you can see the emphasis during the day was to actually close it higher, get that new high set by the bulls, and they achieved that objective. So did that also happen in other markets? Here's the Qs, even a bigger proportionally in terms of a move, and it's got set itself quite some distance now between that last low there. And so mega caps back in charge again. Most of them anyway, not every one of them, but most of them back in charge. The diamonds. Now we had a very robust high signal to noise move all the way from November. So the Dow's, really had a great attraction, I guess, on the back of, the other market. The Qs, the NASDAQ 100, and even the SPY was up so much for the year, and Dow really hadn't participated at that point. But everything kicked in, and then started to get a broader market rally, started to get some rotation into things that had lagged, and this is what you saw. And now it popped back up, but you're not getting that as aggressive of a move, again, because this is a price-weighted. This is the tracking stock of a price-weighted index rather than the market cap weighted index of the SPY and the Qs. So plays out differently, right? Depends on the leadership in the other ones, and not so much here. Although stocks like Boeing and things can exert a big impact on the Dow in any given day, but not the same in terms of behavior as what you see with the SPY or the Qs. Here's IWM. It is suffering compared to the other indices. So it's hurting. It did have a good day on Friday, so there's a little bit of that Me Too kicked in, a little bit of sympathy for the strong, robust day we had, and it kicked in. But overall, it is certainly languishing this last few weeks here. Okay, so as we came into the beginning of the year, it's been hurting, and the other ones have been holding up okay. Here's the sector performances for Friday and for the week. So Friday, technology, communication services, real estate, consumer cyclical, largely more risk on all of these. Down here, consumer defensive was in last place, utilities, healthcare, and industrials was kind of in the middle, but as it often is, actually, it very rarely is the leader or the lagger. It's always kind of in the middle. So just so you know, I mean, boring is beautiful. That's kind of where you want to live, is in the industrials area a lot. But consumer defensive lagged. And for the week, it did better. Consumer defensive was number 5. Technology was still in the lead for the week. Communication services as well. And cyclical was down here. So really the week went to risk on overall. But there were a couple days when our defensive list just did better than the risk on list. So you can have that. You can still have a risk on type day where the list itself doesn't necessarily perform as you would expect, because it depends on the selections in there. And overall, the game is if you get a large gap, how can you exploit it the best? Sometimes when the market gaps down, the best choice is to go into the higher beta and the risk on. And sometimes when the market gaps up, the best is to actually go into the defensive. So keep that in mind. It's not 100% of the time. It's just a probability skew to it. But utilities hurting as we had a bit of a rise overall for the week in the dollar and the yields. That affected basic materials as well, and also affected energy to some degree. But again, energy always seems to be down in the dumps. So there you have it. Okay, here's a map of the market for Friday. You can see, again, largely the large mega caps and the large caps and the technology and discretionary and so on. And then, of course, healthcare really having it bad. On Friday, energy, held in there okay. Sometimes that's the case because of a weekend. People think their things might escalate, and we do have a problem in the shipping area related to oil coming through the Suez Canal and Red Sea and stuff like that. So a bit of disruption. But here's the market for the map of the market for the week. and Tesla, although it didn't sell down on Friday, sure had a bad week. And UNH as well, and some of the other healthcare. But let me flip this back and forth. Boom, boom, boom. You can see that we're in a kind of market where strength begets strength and weakness begets weakness. Isn't that what they say? It just seems that way, that strong things have gotten stronger and weak things have gotten weaker. Now, we finished a week and we finished expiration, so we often look for a change after expiration. We often look, could the things that performed last week, take a back seat, and the ones that had, were not favored, could they take a step forward? We always have to look at that from a week-to-week basis. So moving on. Since we saw Tesla here have a bad week, let's take a look at it. Here's the streak that's happened really since the end of last year. And this is a complete opposite to what happened the year before. The year before, Tesla was selling down, down, down all the way to 2 days before the end of the year. And then it started its rally in January and kept rallying and pretty much, held in for the whole year. But this is the opposite. It was doing pretty good in November, December, and then it's sold off in January so far. Now, there's a lot of competition on the horizon, and there's lots of consumer choices now, and there's going to be more, and also costs, prices are lower for some of the other manufacturers. So I just wanted to take a look and see how is the for the week, how did the other automakers perform along with Tesla? So what we have in here is, auto manufacturers, and some of them are in other countries and so on. But here's what happened for the week. We've got, that's a $2 stock, Polestar, $1.14. So a lot of cheap stuff down here. That one's not doing anything. Toyota, well, that's a $200 stock, is doing pretty well. Had a good week as well. This one's $11. Livewire. Bluebird, 25. There's Honda Motors, not as strong as Toyota. So then there's GM here. And then here's Tesla down here for the week. Let's go to the next page. We can see some stuff that really having a hard time. Mullen, here's Fisker. That was that thing has been sliding for a while. It's almost off the board altogether. I mean, not every auto manufacturer is going to survive either, right? Very competitive landscape. A lot of things to overcome, of course.
But is Tesla an auto manufacturer or a tech company? So that's
I know.
It's not like Ford. You know?
No. So anyway, you might want to take a look. There's Rivian. It's been sliding as well. Just as Tesla has been sliding for January, so has Rivian. I do see more Rivian trucks around and vehicles around than I used to, but and then Lucid, that with all the Saudi investment and all that, look at that thing. Its market cap now is about $6 billion. It's had a pretty big slide, down at $2.71 now. So anyway, that's that. Moving on. Nvidia went the other way. So there's Tesla sliding all the way down. Nvidia rallying up since the beginning of this year, and it just keeps powering up and getting stronger. And Friday had a pretty big day. So let's take a look at
it's like
how
they're funding the purchase of Nvidia by selling Tesla. They're totally
yeah. Well, that's not so far-fetched. If you were looking to create a relative performance type pair where you're long something that has good prospects and is strong, and short something that's facing a lot of challenges and weak, well, there you go. Both would be working for you, right? Long dollars are working and short dollars are working. That's what you want in a perfect world. But it's insulated to some degree in terms of, if the whole market just suddenly started to implode, probably both stocks would go down. When you have bigger catalysts, you get more of a market of one. And then when the market doesn't have those catalysts, then that's where the real separation happens. So it wouldn't be safe as having a very related long-short relationship, but I mean, it still offers a little bit of protection. But sometimes I find, even if you're creating what's called an anti-pair, like two stocks that aren't related, but yet you want to exploit that, I like putting them in a spread and then actually watching the spread, because it's easier to see it smooth. It takes out some of the noise. And you can really pick up on that divergence or convergence in those, two instruments that you're trading. And also it feels differently, because when the market rolls over, you might see at that point that they both pull back. The market rallies, they both might rally a little bit, but one is obviously outpacing the other one. So it just gives you a different feel being in a spread trade than being naked, if you know what I mean.
Mm-hmm.
Tried it before, right? So you got it. Now, for all that NVIDIA has been doing, it's still not the one that had the most performance for the week. NVIDIA came in at 8.52% for the week. Qualcomm was higher. Avco, and we don't trade it that much, is $1,200 a share. But Rambus came in at 10, SGH 11, ARM at 12. TSM was a big catalyst for AMD this week, and TSM's earnings. And so AMD took it with up 17% this week. But it's not the leader for year to date. NVIDIA is at 20 and SGH at 20.92. So it's still a little bit behind year to date. And over full year, Of course, NVIDIA is up 242%, where AMD is only up 147%. And then on the other side of the equation, you've got things that not performing at all. So down here in the dumps. All right, enough of that. So here's the US dollar. Dave and I talked last week about watching for this breakout and using it. So we were in a channel and we moved in this direction very significantly. And that did rock a number of sectors. Okay, so that was Monday. Sorry, Tuesday was the first trading day of the week. Tuesday, Wednesday, Thursday, Friday. So on that Tuesday, that rocked a lot of sectors, and we pushed all the way up to the 200-day moving average, and so that was a good alert for our community. Dave there was saying, "Hey, watch the direction of the dollar and use it to your advantage." So the 10-year note that moved down and hit the 50 moving average here and bounced and closed right at the 200. So that moved that way, which meant that yields went up. The dollar responded as well. That's impacted by yields, and some pretty good movement in the course of the week. But on Friday, it did dip and hit the 50 and back up to 200. So that reversal there contributed to the rally that we saw on Friday. Now, third Friday of the month on our seasonality calendar was supposed to be pretty positive for IWM and for the SPY, and for the Qs and just the other stuff that you put in here too, if you had checked them all. So it was a positive day. Here's what the stocks looked like at 84% of the universe of 294 that are being represented in this universe based on how these sliders are set. Were positive by percent change. Only 16% were positive by percent change, so negative in that sense. Not all of these would have been candidates to trade. We see that, odds of going down, you want higher odds of going down. So this 83.3 is kind of more appropriate, 75, but when you get to 25 and 37, I wouldn't take those. So if we just took some of the ones here that are most robust, and then on this side as well, we have to take the ones that are the most robust. What do you get? You get this. So there's 15 and 15. So I included some that were, 50% chance, but the percentages were okay. So just to even it out and have 15 by 15. But I just want to point out something here, is that this was the net change close to close, 1.53 versus 0.77. So if you had bought these longs on the close the day before and held them over, that's what you would have got. If you shorted these at the close the day before and held them over, that's what you would have had to pay. So obviously the gains are higher than the amount that you lost, which was a good return on capital if you look at it that way. Now, that's not what you experienced if you bought all these at the open and shorted all these at the open and held them to the close. You can see that performance was slightly lower on the longs and the shorts, so you would have lost money. Now, the ones that aligned in our lists contributed positively to the outcome of the lists for Friday. We find that on average for bigger events like expiration or first day of the month or last day of the month, or even first Friday of the month, there is a contributing factor by seasonality, even from the open to close. But what I wanted to demonstrate here is by taking such a large list of 15 by 15, that from the open, you had less performance from your longs than your shorts, so you would have lost money. But what I want to point out is, look at the gap On average, the gap was 1.13 for the longs, and down here was 0.04. And the biggest problem was that Wayfair gapped up 13.95% and then pulled back 3.22% to close up 10.28. So actually, from the open, it was a weak stock, but from close to close, it looks like a very strong stock. But you wouldn't pay that. If you were doing a list and you spot check to see how these were set to open, that wouldn't have been one that you would have said, hey, I'm lining up to buy that up 13, almost 14%. It would not be included. So my point is, watch for these outlier type gaps, because you don't want to pay that, because this is what you will often experience. You will often have a pullback of significant magnitude from something that opens really extreme. So if that had been taken into account, then that would have, and you'd eliminated that altogether, you would have improved this number here tremendously, right? It would have been closer in line, right? But still, most of the time it works out where your longs do outperform your shorts even from the open to close. But there is still a benefit sometimes, depending on discounts that you get, to actually go in and take it from like an overnight trade. That's where you get good benefit in the turn of the month effect, taking it from the close of the last trading day of the month to the open or to the close of the first trading day of the new month. That having that turn of the month effect work for you could often mean not just participating in the symbols from the open to close, but actually engaging them if they line up right the way you want, and taking them overnight. Okay. Now, imagine that you had Wayfair overnight. You could have sold it into the gap up almost 14%. Now, that would have been pretty robust, right? So that would have been even better for you than this close to close change, because it did drop from the open to the close. So there's lots of ways to slice it. The other thing I want to point out is, with these types of lists, you could have done the long and then, use the SPY or use the diamonds or use, or sector ETFs. You could have made a compilation either of one ETF like the SPY or a number of ETFs and worked it that way, so that you didn't also use an equivalent amount of shorts. If you're tighter on capital, sometimes that's the better way to do it, is to take your best insightful symbols that you can do some homework on, along with the seasonality calendar, and take those, select, and then have your ETF standing by. So lots of different ways to slice it. Okay, Dave, what do we have with the economic calendar?
Yeah, so early in the week, there's not much going on. There's some U.S. leading economic indicators on Monday, nothing on Tuesday. And Wednesday, a little information about how the services are doing versus manufacturing. But the big thing is on Thursday, we have this Q4 GDP report, and that shows us how the economy is holding up or not. So that's going to be an important one. And there's also some housing data, new home sales and retail. And on Friday, there's personal spending and income. So how is the consumer holding up? So the themes for this week are really on Thursday, Friday, how inflation is doing in terms of affecting the growth of the country, the GDP report, and then how the consumer is holding up with that inflation. So those are the key things in terms of economic reports.
Any earnings reports?
1 second. Let's see that.
And then you had some thoughts maybe on some of the, since the market's made brand new all-time highs, any symbols? How many symbols are making brand new highs?
Yeah, so I took the S&P 500, and there was 60 52-week highs out of that 500, but it was very skewed to the big caps, the large caps. So,
yeah, right.
If you look at the IWM in December, all the talking heads were saying, "Oh, come 2024, it's going to all reverse. It's not going to be led by large caps anymore. It's small caps, right? And then as soon as 24 hits, it's the same story as last year. The big seven and the mega caps are still leading, and they're making the new 52-week high. So it's almost contrary in the talking heads, but it's like the same story as last year.
Right. Well, let's take a look at, while you're looking up earnings, if there's anything, I'll just go and
There are
send
two, actually.
you.
Tuesday, we have Netflix. That's an important one.
Okay.
And then Wednesday, Tesla. So that's appropriate. You were just bringing up Tesla as a chart. So
we'll see if anything changes the narrative there, because it's been facing some problems, but maybe the selling's done and maybe there's a new catalyst on earnings. And it's also the conference too, like, the analyst meeting, Q&A and stuff like that. So keep that in mind.
And Thursday, there's Intel. So there's a couple of good big ones this week. Yeah. Netflix, Tesla, and Intel.
Those are big names, and they could have market influence as well. So since the futures opened, we popped up right away when they opened at 6 p.m. Eastern time. We roared to a high 2 hours later, and we pulled back from that a little bit. There was some China participation, and some excitement in some of those stocks, I guess, but it seems to have faded. S&P 500 is a little bit stronger than the diamonds. Let's take a look at the Qs where we have all our technology. That hasn't pulled back much after the rally, so we've had a pretty good spurt here. So the problem with new market highs is there's nothing to lean on. It's like blue sky, right? Nothing to lean on, no numbers to lean on the upside, so keep that in mind. Russell has lots of numbers to lean on, so that's a little different. But it's also elevated. And the VIX has been pulling back again from where it popped up to. Now it's pulling back. Take a look at our metals. Gold should be suffering a bit because of the dollar. So let's look at the currencies here. US dollar, since they opened at 6 p.m. It's hanging in there okay. So that brings us to the next slide here. Other items and food for thought. So Argentina president's address to WEF should be required reading in every school, college, and university in North America, in my opinion. And it's just an incredible address. If you guys want to look it up, I think that he's making a big change in Argentina, and what he presented in his speech to the Davos WEF meeting there was what should be thought about and taught in our school system for sure, because we've drifted a long way to socialism in terms of mentality and activity. So I think that's a really good thing to take a look at. And then we also had the WEF panel discuss Trump as a threat. You saw all of them yakking about that. And then DeSantis now drops out. He blasts Haley and endorses Trump for president. So the Trump impact. So we don't have to wait to the elections, because something could change between now and then. But if this is what's happening now, in terms of getting more traction, then that could impact various things. So you have to take a look at his 2024 platform and what the emphasis is on. So that could affect the dollar and treasuries, could affect oil, could affect pharmaceuticals, could affect the military and law enforcement spending, and could affect industrials and construction and even big tech. So all those areas to me are something to watch, because if his currency is rising in terms of potential, becoming elected president once again, then the market's going to start factoring. And these are the areas that could be impacted. So keep that in mind. And defense contractors could actually sell off. So the question I have is why? So we would expect more spending, but of course the problem is, that has to go through the system, and actually the budget has to be increased. And he still may not be able to do that depending on the lay of the land with the House and Senate and all that. So it might not be possible to increase the defense budget. But the other thing is, I remember Europeans and other people from around the world telling me that when he was president before, that the world was safer, and we didn't need all this stuff. So I mean, he has banter about what he'll do with Ukraine or solving the Middle East thing and all that. So who knows whether any of that's possible? But the defense contractors might actually see less revenue, especially if the entrenched interests in terms of the warmongers, that keep things going all the time and benefit from it. If that actually gets addressed, then the defense contractors could sell off. So it has to be looked at two ways. One, that there could be a lot more emphasis on building up our military, and at the same time, the defense contractors could respond that way, or they might actually sell off. I don't know what you think, Dave, but I like to look at things, both ways, right? Two scenarios, So RFK Jr. could actually contribute more to a Trump victory than most people realize. The reason is because maybe in the dilution of the votes that could go to, the Biden situation or whoever else, if it's not Biden. So he could pull some votes away that dilute that situation and actually contributes more to Trump's victory. So I don't think anybody thinks that he has a chance of winning presidency, but he certainly could help contribute to a Trump victory indirectly as a Democrat. So look at it that way. Recent consumer sentiment shows confidence in the economy and inflation. Those are the numbers we're seeing. And if the economy is this strong, July might be the first rate cut. Have you been noticing, Dave, the CME projection tool there? The Fed Watch tool has been dropping because we had it really high for May, and then it moved up to April and March even, and really high. And it's been dropping for those months. And I think, if the economy is still robust and the labor market still robust, it could be July that's the first rate cut.
Yeah.
And especially if, going through the summer, Trump is getting more traction, and, the Democrats want to fight back and boost the economy, indirectly. That happens. We know it happens. Anyway, Russia suspends LNG exports. There's a lot going on in terms of and that was because of the drone attack. There's a lot going on in terms of disruption to energy related things. So I'm still expecting that we could have a very discounted energy market perk up its head. Maybe Trump contributes to that a little bit. Maybe the shipping thing that we talked about last week contributes more to it. Maybe the expansion of war throughout the Middle East, contributes to it. But it's certainly a contrarian play at this point. And then I don't know if you guys saw the WEF stuff about the carbon tax and some of the debates that were going on, but basically Saudi Arabia put forward that there's 600 million people in Africa that have no electricity at all, and should they not be allowed to tap into all of their natural resources, both natural gas and oil, and grow just as the developed nations have used, fossil fuels to reach the status that they currently have, right? So we didn't reach the status that we had. The developed world didn't reach it based on solar, right? It did it based on fossil fuels. So that's the argument. Anyway, there was a lot of different things put forward, but we've been fearing this sort of carbon tax, what that might look like, but it seems pretty muddled when you listen to all the different contributions to both sides of it. So anyway, we'll leave it at that. Just food for thought, different things. And the market factors in everything that it knows or can anticipate. It just doesn't factor in surprises. Okay?
Good luck.
All right. Take care.